Provision for depreciation, practice question 1. The following is a schedule of non-current assets for records of N graphic. As you can see here, the non-current assets are land and building, equipment, fixtures and fittings. The opening balance of land and building at cost 90,000. Provision for depreciation at the start of the year is 6,000. At the end of the financial year, additions at cost of land and building 25,000 and there isn't any disposal. Equipment. At the start of the year, 1st Jan 2024, cost of equipment 45,000. Provision for depreciation at the start of the year 13,500. 31st December 2024, additions 15,000, purchases of equipment, and then disposal at the end of the financial year 8,000. Fixtures and fittings at cost at the start of the year 12,000. At the start of the year, provision for depreciation 5,200. Depreciation policy of RAFIC. No depreciation is charged on land which costs £40,000. Buildings are depreciated at 2% per annum straight line method. Equipment is depreciated at 20% per annum straight line method. Fixtures and fittings are depreciated at 10% per annum using reducing line method. A full year's depreciation is charged in the year of purchase, and a half year depreciation is charged in the year of disposal. Additional information. All non-current assets additions were paid by bank. That means in the description you write it bank. All disposals were transferred to the disposal account. The equipment disposed of had been purchased on 1st of Jan 2022. Question A. Explain why RAFIC needs to charge depreciation on his non-current assets. Calculate the depreciation to be charged on the equipment for the year ended 31st December 2024. C. Prepare for the year ended 31st December 2024 the equipment account and provision for depreciation on equipment account. D. Complete the extracts from the statement of financial position at 31st December 2024 for the non-current assets. E. Evaluate RAFIC's depreciation policy for equipment. Now, let's answer part A. Explain why RAFIC needs to charge depreciation on his non-current assets. Remember, you gain AO1 knowledge 1 mark, AO2 application 2 marks, AO3 analysis 1 mark. Altogether 4 marks for this question. Provide a clear identification followed by 3 strands of analysis along with application skills. Let's look at this answer. The reason being that non-current assets lose value due to wear and tear. This is your knowledge AO1. Therefore, the depreciation of equipment should be considered as an expense which should be matched against the revenue as per the accruals concept. As a result, profits are not overstated and assets such as equipment cost aren't overstated. Hence, a true and fair value can be shown on his financial statements such as income statement and statement of financial position. The 2 applications given over here is equipment and equipment costs. Part B. Calculate depreciation to be charged on equipment for the year ended 31st December 2024. 2 marks. So here we take only the information related to equipment. As you can see here, we have equipment cost, equipment opening depreciation, we have additions, that means purchases of equipment 15,000, disposal cost 8,000. Now in this case, we cannot calculate the total depreciation by removing the disposal cost. Therefore, we consider the 45,000 the opening balance and the purchaser's 15,000. So we calculate depreciation separately, which is total of 60,000. And then for the disposal, we have to calculate 6 months. Now, where do we get this information from? So let's go back to the question. As you can see here, let's take all the information related to equipment. As you see, equipment is depreciated at 20% straight line method. All disposals transferred to disposal account. Equipment was purchased on 1st Jan 2022. A half year's depreciation is charged for the year of disposal and full year's depreciation for the year of purchase. Now, having all these in mind, let's calculate the depreciation for the current year. So, the disposed equipment worth 8,000 was existing for the year end 31st December 2024, and it's been asked to calculate only half a financial year of depreciation. So 20% straight line method, so you calculate 20% and then you calculate it for 6 months, that is 600. Now let's calculate for the existing equipment, which is 40,000 plus 15,000, 60,000. Calculate 20%, which should be 12,000. Therefore, the total equipment depreciation for the year ended 31st December 2024 should be 12,800. Now this is for 2 marks. Part C. Prepare for the year ended 31st December 2024 the equipment account and the provision for depreciation on equipment. So let's finish with the equipment account. Going back to the question, you have opening balance of equipment 45,000. So let's enter 45,000 of the equipment cost. Equipment cost of this 45,000. On the debit side of the equipment account. And then do we have any purchases? Yes, we have purchases of equipment worth 15,000. In order to add it, you write it on the debit side. It clearly states all the payments were made by check, therefore you can write bank instead of cash. Now let's look at the disposal value. The disposed cost of equipment is 8,000. So let's enter this on the credit side of the equipment account and write it disposal. Now let's balance the equipment account. Remember to write the date accordingly. So debit side is greater. This is the debit side of the ledger, credit side of the ledger. So debit side it's 45,000 plus 15,000 give you 60,000. Write it in the total. 60,000 take away 8,000, 52,000. End of the financial year, already it's written, so you don't have to rewrite it. Balance carried down. Bring it to the opposite side, 2025, Jan 1st. Balance brought down and the same value, which is 52,000. Now we had completed the equipment account. Next question, part 2, is to calculate provision for depreciation account. We already did that in part B. Now let's post the entries to the provision for depreciation account. So you'll need the opening balance of equipment depreciation, and we already calculated this in part B, which goes to income statement. Now we need to calculate the disposed depreciation for equipment. So let's enter the figures which we already have. So you can see here equipment opening depreciation is 13,500. Let's enter that on the credit side. Now we have calculated depreciation for the current year, which is 12,800. Let's enter that on the credit side, December 31st income statement, and we would write 12,800. Now we have to calculate the disposal depreciation. As you can see in the question, the equipment disposed of had been purchased in 1st Jan 2022. So, need to find out for how many years this equipment was used in graphics business. So, it was purchased on 1st of Jan 2022. The financial year ends on 31st 12 2022. The next financial year should be 1/1/2023 to 31st 12 2023. And now we are preparing the accounts for this financial year, which is on 1st of Jan 2024 to 31st December 2024. And the question again demands only half a year of depreciation should be provided for the disposed equipment. Now we'll go back to the question and see where that statement is. As you can see here, a half year's depreciation is charged in the year of disposal. So, we only calculate half a year depreciation, the disposal for the current year. Right. So, what is the disposal? Disposal cost of the equipment is 8,000, which we already entered before. So, 8,000 into, now let's go back to the question and figure out what is the percentage. It's 20% straight line method. Let's plug in that to the formula. 8,000 into 20% for the first financial year is 1,600. For the second financial year again, since it's straight line method, 8,000 into 20 over 100, 1,600. And the third year, it's 8,000 times 20 over 100 into 6 over 12, because we only calculate for 6 months. In one financial year, 12 months, therefore half a year means 6 months. Therefore, it should be 800. Now, let's add up all these figures and you end up getting 4,000. This should be the total depreciation for the disposed equipment. Now, let's apply this to the ledger. Now, let's balance off the ledger. Debit side, and there's a credit side. As you can see here, credit side total is greater. 13,500 plus 12,800. Now let's balance the equipment provision for depreciation. 13,500 plus 12,800 should give 26,300. 88 in the total. From this you take away 4,000. Should be 22,300. So this is at December 31st. Balance carried down, and 2025 Jan 1st balance brought down. Should be the same figure, 22,300. Right. So now we had balanced the two ledgers. So now the next question is, complete the extract from statement of financial position at 30th April 2016 for the non-current assets. First non-current asset is land and building. You have a cost of 90,000. However, back again in the question, it states that no depreciation charge on land for worth 40,000. You calculate for the remaining of the building, land and building, 2% straight line method. Let's go back and we're going to finish the calculation. So you have 90,000 opening balance. You purchased 25,000 worth of it. Therefore, you have 115 worth of land and building. So you write that in the cost. However, when you calculate depreciation, you remove 40,000 because there is no depreciation for the land. Land is worth 40,000. So the remaining should be the building cost, which is 75,000. Calculate 2%, which should be 1,500. Now this 1,500 is only for the current year. So you have to take the opening balance 6,000 and add with this 1,500, as you can see here, and it should be 7,500 that should be transferred to the statement of financial position. Now let's complete the equity section. As you can see here, you have the total equity value of 52,000. That's the cost. You have 45,000 over here, and then you have a purchases for 15,000, and take away 8,000 disposal, which should give 52,000. Once you're done with that, go back to your equipment provision for depreciation account, and you have balance brought down worth 22,300. So let's enter that over there, which is 22,300. Now let's find the book value, which is 52,000. Take away 22,300 should give 29,700. Fixtures and fittings, you have 12,000 opening and purchases of 2,000. Therefore 12,000 plus 2,000 should give 14,000. So 14,000 should be the cost. And let's calculate depreciation. The depreciation method should be, as you can see here, fixtures and fittings are depreciated at 10% using reducing line method. Therefore, in order to calculate depreciation for fixtures and fittings, you take 14,000 the cost, take away the accumulated provision for depreciation. Therefore, the book value should be 8,800. Calculate 10% of it should give 880. That should be the current year's depreciation for fixtures and fittings. The opening balance is 5,200 at the current year's 880. Therefore, it should be 6,080. Now let's figure out the book value. You have 14,000. Take away 6,080 should give 7,920. Now let's total up the carrying value column. 107,500, 29,700 plus 7,920, which is 145,120. And let's total the accumulated column, which is 7,500 plus 22,300 plus 6,080, which should be 35,880. Now let's total the cost column, 115,000 plus 52,000 plus 14,000, which should give 181,000. Now we had completed part D, extract from the statement of financial position as at 31st December 24 for the non-current assets. had used a different sample answer so that you can try for the straight line method in your own. So let's assume that Rafik used reducing line method of depreciation in this question. In that case, how will you respond to this question? However, in this question, straight line method is used for equipment by Rafik. So you rewrite your answer using straight line method. So let's see if Rafik used reducing line method, what would be the impact? One advantage of using 25% reducing balance method is that it gives a more realistic charge in the early years. This is because equipment loses value faster when it is new and used heavily. Therefore, the depreciation matches the actual usage and gives a more accurate carrying value in the financial statement. However, that's the second paragraph. One disadvantage is that depreciation becomes very small in later years. This is because percentages apply to a reducing net book value. As a result, profit later on may be overstated, and the equipment may appear to be worth more than it really is. Your judgment. Overall, the policy is suitable because equipment does not lose value quickly, so reducing balance is appropriate. However, Rafik should review the 25% rate regularly to make sure it reflects actual wear and technological changes, so the accounts stay accurate and reliable. So you can see this is a sample answer for reducing line method. Now you can try for straight line method. So AO1 yellow is your application skill. You can see throughout application is there. AO3 your chains of analysis, and AO4 for your paragraph 2 and paragraph 3 the judgment.